Today, we're going to talk about 10 401k mistakes that could be costing you big, and some of these are new for 2023. So let's get right into them. Starting with number one, let's talk about tax credits. By making a contribution to the traditional side of your 401k, you could be reducing your total taxable income and potentially qualify for additional tax credits. Now, what are those tax credits? If we take a look at this list, these are a list of potential tax credits that you might qualify for. So let's talk about some of them. Let's take a look at the Savers Credit. By making a contribution to your retirement plan, you could potentially qualify for an additional $1,000 or $2,000 if you're married filing jointly in tax credits. That means you're going to pay $2,000 less in total taxes. Another tax credit that you might qualify for is the child tax credit, which phases out at either $200,000 for singles or $400,000 for married filing jointly. So by saving more money into your 401k, you might qualify for more child tax credits. And then there's the child care tax credit, which could be up to 35%, but goes down to 20% if your income is over $43,000. So if you have one qualifying child, that could be up to $3,000 in total expenses, or two or more, that would be a total of $6,000. And that is the maximum amount at 20%. That means you can get a tax credit if you're at $6,000, and 20%, that's $1,200 of an additional tax credit. And then there's the educational tax credits, like the lifetime learning credit. And that could be up to $2,000, which is 20% of a maximum of $10,000 of qualifying educational expenses. Number two on this list is lowering your taxes or your tax bracket. Let's say you're earning $100,000. Your total tax bill would be $8,236 if you're married filing jointly for 2023. But let's say that you save $10,000 into your 401k. That would drop your tax bill and save you an additional $1,200 in taxes. But this depends on how much you earn and what tax bracket you're in. So for example, if we increase our income to $200,000 and save the exact same amount, we'll actually save $2,200 in taxes because we're in a higher tax bracket. And if you look at this another way, if you're just above any of these limits for married filing jointly, or if we flip over to the singles, above any of these limits for singles, getting right below it could save you this amount in total taxes. So every dollar over $44,725 up to the $95,375 would be taxed at 22%. But if you can get it below this amount, then you'd only be paying 12% on each one of those dollars. So when it comes to your tax brackets, what you want to do is smooth out your taxes. So in years you've earned a little bit more, put more money into the traditional side to reduce your total tax liability. But in years that you've earned a little bit less, then put more money into the Roth side of your 401k so you can smooth out your taxes. Number three is going to be looking at your matching contributions. Now that means the amount that you're putting into your own plan, your employer might match those dollars. So you want to be very aware of this. So here's an example of someone that's earning $100,000 per year, and over their lifetime from age 30 to 65, they're going to save 4%. That total amount at an 8% rate of return could grow to $878,915. Now let's see how much we can add just by getting that 4% match. And because of those matching dollars, it's going to double to $1,757,806. That's almost $900,000 more day one of your retirement just by saving into your 401k with a match. Number four on the list is actually a new provision to 401ks, and that is the ability to save those matching dollars directly into the Roth side. Previously, all the matching contributions had to go to the traditional side. Even if you saved into your Roth side of your 401k, those matching dollars were required to go to only the traditional side. But now those matching dollars you can elect, if your plan allows, to be put directly into the Roth side. Number five on this list is the true up feature. Now, this is a provision that not all 401ks have, But if yours does not have the true up feature, it is extra important that you pay close attention. So if you do not have the true up feature, by making a contribution to your 401k, you're going to get a match, but that is on a per paycheck basis. So what this means is that if you're not saving in the beginning of the year because you have some bills or expenses that you want to pay off first, and then you start to save later on in the year, even if you play catch up, your 401k match might not actually catch you up to the full amount of your match. So even if you put in double, say from 4% to 8%, your 401k might not actually increase that amount. So your total amount for the course of the year would work out to 4%. So you want to make sure if your plan has or does not have the true up feature. Number 6 on this list is investing for the long term. Now, there are two parts to investing for the long term. The first one is, what is your rate of return that you're targeting during your working years? And the second part of that is realizing that your retirement is day one of the next 30 or 40 years. If we look at that same example as we did before, where we're saving 4% all the way up until retirement at age 65, this had no match. So we're showing $878,915, and we're targeting an 8% rate of return. But let's say that we were a little bit more on the conservative side and not fully investing in the stock market and dropping that rate of return by 1%. So to go from an 8% rate of return to a 7% rate of return, just because we were more conservative, could end up costing us the opportunity to earn an additional $155,000 in our 401k. So make sure that you're investing for the long haul and working smarter, not harder. Now, number 7 even pains me to think about, and that is making sure that you're investing those dollars inside of your 401k. So often I run into 401ks that have been saved in for years and years, and unfortunately, they never actually invested the dollars when they were certain that they had been. So what you want to make sure of is not only that you're invested, but if there is a mistake and you need to actually get those dollars invested, you want to make sure some plans have two sides to it, the current dollars and the future dollars. Just make sure that both are being invested the exact same way so you have full control over your investments and those are working harder for you. Number 8 are the limits. Know the limits, know the changes. Let's take a look at these. For 2023, it's going to go up to $22,500, but there's also a total contribution of $66,000. If you're 50 or older, that goes up by $7,500 to a total of $73,500. A lot of times I see people who think that the match is the maximum amount, and that is not true. It is the $22,500 for 2023. But above and beyond that, that is only the employee deferral and not the full amount that could be contributed. That is the $66,000. Which brings me to number 9, and that is so important to know, the non-deductible contribution to your 401k. So you can actually go well above the $22,500 and make sure that the total plan can actually have up to $66,000. And that is also known as the mega backdoor strategy, which is not subject to the pro rata rule. So that means you could potentially save quite a bit more than just the $22,500 and get a ton more money into the Roth side of your 401k. And number 10 is actually knowing that you can save into multiple retirement plans, including the traditional IRA at any income level. It's just a matter of whether or not it's going to be a deductible or a non-deductible contribution to that IRA in addition to your 401k. And that is 10 401k mistakes that are probably no longer going to cost you big. If you've enjoyed this video, be sure to subscribe and we'll see you on the next one.